I mean, ETF is useful, but really depends on how the user use it, right? It can be like, let's say, a knife, right? You can use for your advantage, you can use to hurt somebody. So it really depends on how you use that tools to your full advantage. And education is important. Financial advisory is important to make sure that individuals do not do, I would say, things that hurt their portfolio.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And I think today there's also a new interesting discussion that we have, right? Primarily within this discussion of ETFs, because my guys told me, hey, let's do this episode because apparently there was some article talking about ETFs is a thing among millennials, right? So I've got some friends on the show. For audience that don't know you, would you like to introduce yourself?
Hi everyone, this is Wei Chin. I'm from SGX.
Yeah, next door only. Walk over only.
So I'm the product manager. So day to day I work with the issuer to bring more products to the investors, as well as to work with the financial industry player like yourself to educate investors on the use of ETFs.
Okay, so would you say that from a product standpoint, it is true that there's a lot more people are using ETFs?
Certainly. Globally, ETF now is crossing around 12 trillion. In Singapore itself, is also approaching 12 billion in terms of asset under management. So that's doubled since pre-COVID years.
Okay.
In terms of users, we see it tripled over this period.
Wow. So you achieve your KPI lah.
Hopefully, I think a lot more to be done.
Of course, we can discuss more as we go along, right? And long time friend of the show, but first time in our new studio.
Yeah.
Right. Yeah. But for our audience that don't know you, could you just introduce yourself?
Yeah. So I'm Dave from Minimalist in the city, and I'm also a financial coach that manages my clients' investment. And I've been a long time investor myself. So I think on this topic of ETF, I think recently has been like there's a big boom basically. It's like everyone knows about ETF. Then in our discussion, hopefully we can find out more what causes this boom currently. Because I didn't know that millennial. I'm considered a millennial.
Really?
Yeah, I just
You're
meet the
millennial
cutoff.
the elder one, okay.
Yeah. I just met the cutoff. Yeah, so I think I am in a good position to talk about this.
Okay. But amongst your coaches, a lot of people also exposure with ETFs. Or?
Initially it was funds. So then now they are starting to have more ETFs in their portfolio, basically. Yeah.
Okay.
Yeah.
Maybe for our audience, for somehow they don't know, right? Usually our audience quite sophisticated, So can you just give us an elevator idea of what's an ETF? Just so we get this out of the way, right? We define it clearly.
Sure. So building on what was shared earlier on in terms of funds that was used to be more popular in retail investors' mind, it works as a fund whereby it's diversified. It allows investors to access certain markets, certain theme, if they want to do it in a diversified manner. But when it's exchange traded, means that it's listed on the exchange. So what comes with it is price discovery, intraday trading, meaning the investors can get in and out during the day, and they do know exact price that they are getting in and getting out from the investments. And most importantly, ETFs gives a form of transparency. Most ETF would also disclose its underlying holdings daily. So for investors who are keen to know what they are invested into, ETF gives them the transparency that they do need as well.
Yeah, okay. So in simple terms, ETF is just funds traded on the exchange.
Yeah, and it's typically lower cost because there isn't a need for a middleman.
Is it still true? Because I think a lot of the funds run for their money. They also kena, right? Yeah. So they all kena. So all of them have adjusted their price mechanics, right? So is the ETF market still actually more affordable than the traditional mutual funds and all those type of stuff?
I think if you look at the average cost that's been tabulated across various sources, I think the average price for ETF tend to still be on the lower side. Part of the reason, of course, is apart from the controller fees, or we call the retrocession fees given to distributors, ETFs, most of them are passive today. And when it's the passive index tracking funds, typically the manager tend to charge lower fees because there won't be additional research cost involved.
But that's not to say across all ETFs, right? So like what you're saying is the big index funds.
Certainly.
So those are 0.03% fee structure, right? Very hard to beat. Any lesser,
AUM would have a role to play as well. The bigger the funds, typically the lower the cost.
Yeah. But I think as a term kind of flourishes amongst the audience, then you start to see other people also caught inside ETF, but actually underlying is all sorts of stuff, right? It's not it's not just what people would earlier on associate with the ETF, which is an index fund. Nowadays there are thematics, there are all sorts of weird leverage. I mean, so there are all sorts of stuff, right? So what is that? Could you kind of educate our audience a little bit?
So you're extremely right on that point. ETF started with a pure index tracking. One of the oldest funds is S&P 500, so it tracks the US 500 companies. In fact, the STI ETF in Singapore has already gone past 20 years old by now. It tracks the top 30 companies in Singapore, and probably most investors would know most of the names that are commonly appearing in front of them in terms of the banks, the financial, the real estates, and the local companies that that has been in their mind. And ETF started from there, right? If you do want to gain exposure into a certain countries, for example, Singapore, US, China, ETF allow them to get a broad-based exposure without having to do the work in researching into individual companies. They can achieve market returns in a low-cost manner. These days, of course, ETF has extended into thematics, as you mentioned. A few interesting themes that has came out in recent years, including a good example would be China EVs, right? That was one of the ETF that were listed quite some time back. Recent years, we saw also themes including APAC financials, dividend focus. So these give investors a specific exposure into financial sectors. At the same time, the index screen out companies with higher dividend payout historical performance. So that kind of suits investors when they are looking for a pocket of themes that they are more comfortable investing into. Of course, then those who really want to go into growth, there will be growth sector focused ETFs, including the one that is more commonly traded in Singapore would be the Hang Seng Tech ETF.
Yeah. So those are not simple anymore, right? And those fee structures are not cheap also. 0.5, 0.8, I gotta know all their pricing structure across the board, right? So once you enter the 0.8 space, right, you're not very price competitive anymore.
So I would say that in terms of the ETF usage, right, there is always core and a satellite ETF that you're using. Typically for the core funds, you're talking about things like STI, you're talking about S&P 500, you're talking about probably MSCI China, right? Some of them have extremely low cost, as you mentioned, single basis point. And these usually form their long-term holding. And because these funds typically they hold over a long period, for example, for Millennials, easily another 20, 30 years. So a low basis, sub 30, for example, some even single digit, this allows them to compound their savings over the years. The ones they mentioned maybe at a higher scale, it could be newly discovered thematics or newly launched thematics ETF by issuers. They may come at higher cost, certainly because of the lower AUM, lower scale, or more multi-assets, more multi-markets access that the ETF requires, and that build up the cost within the fund. These could potentially be a satellite funds, meaning that investors may not be holding them for like 20 years. They might be holding it for the next 1-2 years because they do see that the trend for the next couple of short-term years is gearing towards that direction. So that might kind of mitigate the kind of cost impact over long term if they're using this for a satellite exposure. Yeah, and that wouldn't form like a huge percentage of their overall portfolios.
So just to go a little bit more on that, right? Because to be fair, there are a lot of local ETFs that are very expensive, right? I mean, don't need name names, but they're all very expensive, right? It's not the most what do you call that? Not even the most interesting and frontier type ETFs. Your REIT ETFs are going at what, 0.5, 0.65. I think some of your Asian financials they're not that cheap either, right? So why I want to hold you on that, right? It's because a lot of people will market ETFs as cheaper alternative, better for the long term, right? So like, is that actually fair, as a statement? Because these days, like we've established that there are more and more new type ETFs, right? And all these new launches. I mean, I talk to the fund managers I know, they tell me, oh yeah, because this is a smaller theme, there's a smaller fund, so we no choice, we have to charge at a certain price. If not, it does not make sense as a business, right? So from an investor standpoint, is it still a valid option? Right?
That's a fair question to ask. And also, I think a lot depends on market evolutions, right? Because in US, it didn't get to single basis point on day one. As the size of, for example, the 3 largest asset managers in US, right? You have BlackRock, Vanguard, State Street. They didn't get to like $1 trillion AUM on day one, and the products didn't get to a single basis point on day one either. So that really depends on the rate of the market is evolving and the trends of the market is evolving. A good example would be one of our key product on SGX, the REIT ETFs, right? Fundamentally, there is a lot of cost involved because for REIT ETF, there is taxation matters involved. And there will be administrative costs involved by allowing investors to enjoy the tax transparency. And that kind of has built into the cost structure. And we do see issuers are proactively reducing. For a good example would be Nicole AXJ REIT ETFs. That has recently dropped to 55 basis.
Yeah.
So we did.
There's a reason they are one of the biggest around. So
They are one of the biggest, and I think the issuer belief is that as the AUM grows bigger, they are more than ready to lower the fees. Again, going back to the STI ETFs, both STI ETFs today are trading, or rather are being managed at sub 30 basis point, closer to 26 to 28, depending on which one you're looking at. And there is also evidence that fees can continue to come down, even though they are among the lower cost ETF in the market today.
Okay, fair. Then, Dave, what you think from your point of view, like people that buy funds and all that? Yeah.
I also kind of like shifted from funds to ETF. I think it's a natural move because both are basically, they have the same objective.
The underlying thing is the same,
Yeah,
more
it's
or
the
less.
same. Yeah, more or less, right?
Yeah.
Then I think currently all the mutual fund managers, right, they are trying to decrease their cost, right? Trying to go to as close as ETF as possible. So my question will be like, going forward, right, once this gap closes, right, what will be the implications for future, like to the selection of funds and ETF? Because I think one day they will get it, they will be very big and then they will be very efficient, right? And then the cost, they can actually drive it down all the way until you can match the ETF. So what if the day come like, I think the next 5 or 10 years? I don't know when it will come, but then there's a possibility of that coming true too, right?
Certainly,
Yeah.
In fact, the day has came, right?
And I don't think it's because the fund size got bigger. You know, the mutual funds were the dominant fund at first.
Yeah,
it's because the
they're
ETF
already dominant.
gave them a serious
That's
run
right,
for their money.
correct.
No choice, right? They all have to bring down their funds. Every agent that go out and talk all say, "Wow, sell liao, cannot sell because the ETF is so much more affordable."
Yeah.
Right? So the ETF as an innovation from 20, 30 years ago has gave a run, all these funds a run for their money, and the cost structure has just changed, no choice.
So a perfect example, if you look at US, index funds is extremely popular as well, right? It is in trillions of dollars. Yet ETF is growing much faster in US. So there is certainly different audience who prefer to use one over the other as a vehicle, right? In simplest term, unlisted funds, unit trust funds, typically they needs to be distributed by a distributor. You need to buy it through a platform, and certainly the platform today, even if they don't charge a sales charge, they do need to have a custodian fee, a platform fees, right? That's their business models. But in ETFs, it's a bit more unique because it's distributed by securities brokers. There will be trading fees involved, which obviously I think this is another topic, but we do see that trading fees is going down as well in Singapore.
Right.
And that has given investor another option. Do you want to go through a platform, which is perfectly fine because if you like the platform, you like their service, you may go through them as a wrapper or as a fund selection platform? Or do you want to have the ability to buy yourself, to keep it with your broker, which in Singapore context, most brokers do not charge a custodian fee for Singapore holdings, right? If you prefer that, no custodian, there's no recurring, no wrapper, ETF could still be a way out, even though both fees are the same because mutual funds then have another layer of fees to consider. But if you like the provider, right? If you like the fund platform provider who provides the service, they may have FAs to serve you. Again, nothing wrong. But of course, today we are seeing FA selling both ETF and funds, right? It really depends on the service they provide.
Yeah, a lot of brokers integrate with them already.
Exactly.
Yeah, so
Exactly.
okay. So times have changed, but from a product line standpoint, right? You still see a lot more funky ETFs that are being thrown around, right? So I just want to hear your point of view with like this like inverse leverage, all this stuff. Like, I will call them funky lah, right? Right. Because okay, why I say they're funky? Because the original idea of ETF was really tied to index funds, right? So this term has in some ways been synonymous, but in some ways have been exploited because everything is an ETF, right? But everything under the ETF is different, right? So you have all these funky things, right? So what is your take on it? It's not so prevalent here, or at least that's my thoughts are. But from a product line, maybe you have a different point of view or different optics, right? So what is your take on these things?
So you're spot on the term whether L&I should be in ETF format, right? In certain countries, they may call it the L&I ETF.
Leverage and inverse, right?
Leverage and inverse.
Yeah.
In Singapore, we purposely do not call it an L&I leverage inverse ETF. It's called a leverage and inverse product, or you can call it exchange traded products. There is a distinction between them because one is it can be used for long term core asset allocation, but L&I leverage inverse is never meant for retirement planning.
There's a
It's
serious
for
negative
investors.
carry on those things, right? Yeah.
It's for investors to take advantage of market movement. It's for them to express a view to market events. It's for them to take leverage up position for a very short period of time. It could be intraday, it could be a couple of days, but typically we don't recommend them to hold for anything longer than that. So that is the evolution of what investor wants. So back in a couple of years back, we launched the first pair, leverage inverse. They are mainly on Singapore economy. It tracks the MSCI Singapore, right? So that has exposure to the key sectors in Singapore, like the banking, the real estate, and several others. So that allows investors, when there is market movement, when there's a sell-off, for those who have conviction that there is a rebound, imminent rebound, they may use the 2-time leverage to gain an extra position, or it's mainly for their capital efficiency. So they don't have to put 10,000 for 10,000 position. They put 5,000, they get a 10,000 position. It could be they feel that market sell-off is coming and they want to kind of hedge their Singapore stocks. But you can't possibly sell every stock you have. That's going to cost a lot and it's not that convenient. So the one-time inverse allow them to partially hedge off their exposure because they feel that the market's a bit overheated. Maybe there's a news coming out or there's a turbulence in the market. They want to reduce a bit of the market exposure, but not entirely, and certainly not selling their 35 stocks in Singapore. So the MSCI Singapore do help them to net off some beta they are having in Singapore market. Recently, in fact, not so recent anymore, about 7 years ago, we also started an asset class, product class that is closely resembles leverage inverse product in terms of payoff. They give a little bit more leverage from 3 to 7 times. They are called the daily leverage certificates. And these products allow investors to have even greater efficient use of their capital by using limited capitals to gain certain self-exposure. But word of caution, the end exposure they're having should always be the amount that they're willing to risk and able to risk.
Okay. Yeah. Can you elaborate? What's the difference?
Sure. So leverage inverse product, why in many countries they call it as ETF? Because in terms of the structure, it does follow a fund structure. In Singapore, it's either a unit trust or another structure we call it a variable capital companies, VCCs. But the way it's managed, the way it's custodized the assets, resembles that of ETFs. They do have external market makers as well, so to make sure that there's two-way pricing. DLC, however, typically is issued by a counterparty, typically investment banks. In Singapore, currently we have 3 issuers, SocGen, UBS, and Mirae Assets, Securities. So these are the 3 key issuers for daily leverage certificates. These different...
just again, daily what certificates?
Daily leverage.
Daily leverage certificates. Yeah. Okay.
So they
DLC.
give investors leverage exposure as well as inverse exposure in a
What
leverage
is the
manner.
structure? How does it work?
So it's a form of certificates that's issued by the issuers, which I mentioned the 3 of the firms earlier on.
Okay.
And they will then, in terms of the issue, in terms of investment that investors put up, they will then assure that they will get a payoff if market moves towards that direction. So there is certain form of counterparty risk, right, that the investors is taking, which they should be aware of before they invest into the products.
Okay, and just to be very clear on this, right? So that means when I own this cert, actually underlying there are no asset ownership, right? In terms of like the stocks, there's nothing held under. It's not like a fund, right? Where I buy the fund manager have to buy the stocks, right? Then to make up the index and the fund, then they can sell me that fund, that ETF, which is a unit of the fund, right? Essentially, right? So whereas this daily leverage certificate, we are really just betting on the movement of the market in that sense.
The difference is that leverage inverse product, it will have a trust, typically, if not a custodian, that's custodize the assets. Daily leverage certificates is a bit more agile because it is issued by the issuer, and they have the flexibility in this case to issue different level of leverage They have the ability to also issue certs in single stocks as well. So ETF today, even for leverage ETF, most jurisdictions have it in form of an index. It could be S&P, it could be MSCI Singapore. But DLC, besides index, they also have the flexibility to issue it in the form of single stocks. And recently, in 4th of October, we also issued DLCs on the Magnificent Seven. So today, investors in Singapore, they have the opportunity to also, I would say, express their views in Tesla.
Express their
NVIDIA,
views. Oh, you
in
got all the
Asia
keyword.
I realized I think millennials and people around me, they are buying into a lot of ETFs nowadays, but probably not into the space of leverage yet. But then those are the general ones, right? I realized a lot of them, they kind of because ETF is rather diversified already.
Yes, it is.
Yeah, correct. But then I see a growing trend of people holding a lot more ETFs. So will the over diversification dilute the returns, all these things? Yeah.
So it begins a question, right? Is there really a need to hold 10, 20, 30 ETFs?
I do see portfolio like that.
You may accidentally create concentration.
May
Yeah,
accidentally.
correct,
What kind of weird shit is that?
It's like 20
Please don't
ETFs.
do that, okay? Yeah. TFC don't approve.
Yeah.
Yeah.
So go back to the point I mentioned. I think those investors who has a long list of ETFs, I think the question
I think it's very hard for you to make a comment because it depends on what's the ETF that they actually
Exactly.
own, right?
So the intention and
Yeah.
the purpose is very important. What's the purpose of them holding so many ETFs? Is it because they really have a view in different countries and they want to be more agile in over and allocating in certain countries? Because today single country ETF is very common. You do have single country for India, for Korea, for Taiwan, for Indonesia, for Vietnam, for all the Asia, or even like as far out as US or European countries, right? So the question is, why do they need so many ETFs? Is there over concentration? Because if the concentration, the overlapping is very high, then maybe it makes sense for them to consolidate into just a few ETFs because that makes their rebalancing more efficient.
Yeah, correct.
So that whenever they need to kind of trim off some exposure, they don't need to sell 5 ETF to reach that. They could easily do it through maybe 4 or 5. That save cost. Because one thing about fees is that not only management fees, the transaction cost is important. The more transaction costs you incur when you rebalance, I think over long term, your cost pressure to your portfolio is higher.
Yeah, fair.
Yeah, and also one more thing, right? Because when we build an ETF portfolio, right, initially for me, I follow the lazy man ETF portfolio. So they will have like the Ray Dalio, or they just follow, because we invest in ETF, we want to simplify the whole investing process, right? Yeah, so in that sense, I see people buying a lot of ETF. I'm not sure what are they getting into, it's like, I thought initially you don't want to buy stocks, that's why you buy ETF, so you have a diversified view of the world index or the Asian index. Yeah, but then when you start to get in a lot more into the satellite portfolio, right, then it gets a bit tricky. I mean, your portfolio becomes smaller and then your satellite becomes bigger. So it becomes, I do see that trend. It's like over diversification.
True.
Yeah.
And I think today access to news, and in fact, not even you're not accessing it, it comes to you, right? When you open up a mobile. and
Very annoying, right? Yeah. Every day got weird news come to me.
So the challenges, I think, even not challenges, but maybe challenges that investors face today is information overload.
Yeah.
When there's so much discussion about certain products, certain ETFs, does it mean that you must get into it?
Yeah.
I think so. Going back to the drawing board, right? You should take a look at your portfolio. How would this help you? And do some independent research. Take more source of information before making a decision. I think investors run into risk of, because your friends are doing it, because it's very popular in social media, you follow that. I think that might be a risk. Like any investment decisions, talk to a financial advisors. Or at least do some independent study of your current portfolio before you decide on whether to take on. So you should already ask yourself, how does it help in your portfolio? Rather than buying it with the expectation or with the advice from third party that it's going to do well. I think that's the pitfalls when it comes to investing, not only on ETF but on anything else.
It's true. In fact, I would say do your own research, right? Has become a meme. Right, so I think you do less research is okay. You need to have your framework together, right? Your investment core framework is more important than reading whatever. The more you read, the more you end up in some SEO optimized sales funnel. so yeah, I think for a lot of newer investors or people that are exploring new methodology, you need to understand the methodology, the investment framework, why things are done in a certain way, rather than over flood your information with read more articles, search Google more, what is the best. So those are all SEO optimized to sell you. That is my point of view,
Yeah.
right? So I think spend less time on reading individual products, because after a while, once you have a framework evaluating the product, it's all the same.
Less is more.
Yeah,
right?
yeah. But you must understand your core, investment ideology. Why are you doing this, right? And then from there, additional information to color your decision as to why this ETF and not that ETF. But at the core, this thing is so wonky. I think for a lot of the newer investors okay, no, we're not judging you. This is sharing our point of view, and we can develop from there. So actually, it's quite cool on your end that you guys are not calling all the leverage and invest stuff ETFs. I think it's like how sustainability as a logo, right? You kind of govern that properly, right? So from a ETF standpoint, those are weird things you try not to call it ETF. It's not saying leverage and invest is weird. Sorry, it's just in the idea of long-term, diversified, index fund type of style of investing. You have a segregation from that.
It's to make sure that investors are aware of the differences.
Yeah,
Right?
yeah,
Because
yeah.
the intention is different. One
Yeah.
is for long term and one is for short term.
Yeah.
So they will use it to their advantage.
Yeah. So I think that is quite commendable. Very good. You come on the show, cannot comment by me. Huh? Very good. Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC.
Just now we talked about diversification, over trading, all this due to ETF, right? Because ETF is during market hours. So funds, they still have this advantage of end of day kind of thing. So would that kind of like ETF will promote more trading? I mean, of course, more trading will be good for SGX or whichever exchange. But then from an individual perspective of an investor who is quite passive, will over trading be like really bad for them if they kind of like hold ETFs?
Short answer is yes. Over trading is
It's always bad.
not good because it's over
But,
trading.
but ETFs just make it easier to overtrade, like with the innovation like the inverse ETF, the leverage ETF. I think these are like things that people should really be careful of. Yeah.
No doubt about that. I think we discussed that a bit earlier. Always be sure of your intention to hold certain products. If it is your core asset allocation, it means that it's the core, meaning that it shouldn't be switched out and in and out that frequently. Maybe you do a rebalancing half a year. And you rebalancing doesn't mean you change the entire portfolio. You might trim a bit of the gains that you see in some sectors that you thought you should relocate to some that's underperforming. That's perfectly fine. Maybe within that 4 or 5 ETF, you trim a bit of your bonds ETF holdings, you put into equities because it's overperformed. I think that's fine. Your core, even your satellite funds, doesn't mean because it's satellite, it should keep changing. Satellite just means that for this period of time, you have a view that bonds may outperform equities, right? And certain markets bonds might do better. For example, Asia dollar bond, if it does better, you want to get exposure, use it as a satellite additional to your core. I think that's fine. If you want to overweight sector, like technology sector, because there is a sell-off, for this period of time you want to overweight, I think that's fine as well. But the question is on overtrading, meaning that you are buying and selling just because of emotions, because of fears, because the market is rallying. There is potential. I mean, we do know that overtrading might, over the long term, if you do trade too much, right, the frictional cost might give a downward pressure to your investment returns. So I would say it depends. I mean, ETF is useful, but it really depends on how the user use it, right? It can be like, let's say a knife, right? You can use for your advantage. It can be used to hurt somebody. So it really depends on how you use that tools to your full advantage. And education is important. Financial advisory is important to make sure that individuals do not do, I would say, things that hurt their portfolio over the long run.
Fair.
The liquidity and the ETF, how should investor actually look at that? Because it is something that investor kind of like overlook. the liquidity size of it actually affects our rating.
To be fair, in the funds, it's not so important.
It might not
in those
be,
traditional funds,
Yeah.
okay, not that it's not important. It's not important because there's no market movement as a result of that.
Yeah,
Right,
correct.
you know,
but
but in the-
liquidity will still kind of like determine the ultimate price, right?
Yeah,
I mean,
Yes, it does. It does.
correct.
It will open the bid-ask spread. All those
So
things,
in terms of funds and ETF, right, they still have the liquidity size
Yes.
consideration to have. Right?
As you rightly mentioned, funds versus ETFs. Funds typically has less need for execution on the individual investor's point of view, because for funds, they depends on the distributors to submit orders than to the fund managers. For ETF, you do take on the role to execute your own trade if you are DIY investors, if you invest on your own. So it is important for you to take note of limit orders if you are going to enter into any position for your ETF, and then at what reference price you should take. If you're in the midst of a trading day, typically there's a last traded price, there is a bid and ask quote. They are looking at where the market makers is quoting. All ETF in Singapore have at least one or more DMMs, we call it designated market makers, who is there to make sure that there's a bid and ask quotes with a decent size for you to get in and out of the trade. Beyond that, you should also take reference to the NAV pricing, which is the NAV. ETF had advantage that the net asset value will be shown on the issuer website, right? Typically before the trading even starts. So you will know that where did the fund fair value was at yesterday. And most of the passive ETF, they may also have iNAV, we call it intraday NAV. So on the website, you can see it's refreshed every 15 seconds. So on the website, for example, STI, you will know that where is the indicative net asset value of the portfolio is at. So you kind of put your limit orders price close to that, so you don't get into, I think, the challenge of finding a price or liquidity challenges. However, one word of caution: if you are trading cross-market products, right, the iNAV may not be reflective of the existing markets because some market is closed. So it's at best used as an indicative. You should always bear in mind what price level you want to enter before you place your trade accordingly.
Yeah. I'm always very happy when my trade get fulfilled on
Yeah.
It's like, you're my thought,
Sometimes
right?
you gotta wait very long.
Yeah.
Still
No,
queuing.
but just to add on the NAV, right? A bigger liquidity pool, that means a product with a bigger NAV, it's easier for you to move in and out of it. There are more participants, right? So and there's a general propensity for the cost of that product to be lower. You know, because bigger NAV, right? Bigger
Fund size.
bigger fund size, bigger AUM, whatever words you want to use, right? That essentially the fund is bigger, the manager can charge less to stay profitable and continue to run the fund, right? So bigger NAVs tend to have that, you know. So some products, they may promise you, you know, higher returns, you know, depending on what products you're going with. But if the NAV is very small, right, you got to be prepared that, you know, in times of when you want to exit, right, it may be a bit harder, right? It's not so liquid, essentially, for in simple terms. Okay. But you guys are forever building new products, right? And as with all developing industries, I think you do need to keep up with new products. And I think recently I saw an email inbound from your team. We launched a new product, something to do with China, you know, SDRs and
Hong Kong SDRs.
Hong Kong SDRs,
Yeah.
right? So maybe kind of, since we are here, right, you know, extend, you know, some education for us. What is this? What
So
you're
for
doing?
SDR, it's not that new anymore. Started from Thailand SDR. So our first investors access to Thailand market, which actually is not that easily accessible across most broker platforms in Singapore. If they do, then the cost is pretty high because the broker tend to charge a higher cost for such emerging markets.
Can you give us a bit of numbers to help us anchor what does cost high means?
Not for me to comment on.
Okay.
But generally higher than Singapore stocks. Put it that way.
Okay.
Right? And we started with Thailand SDR, as I mentioned. Today, there are already 8 of them. The offer is investors into different sector leaders in Thai market. Hong Kong SDR is very new, as you mentioned. Just started with barely a week over, and we are seeing good traction. Few reasons for that as well. There are currently 5 names that are on the market. A lot of them are popular names which investors already know by now. It includes BYD, Tencent, Alibaba, HSBC, Bank of China. These are the 5 products, or rather underlyings that is brought here. Why did we decide to do that? Because we do recognize the fact that investors in Singapore, 2 challenges when they try to access some of these underlying. One typically is currency, right? So when you access different markets, including the US markets, the challenge is always FX conversion, right? How much is the broker charging you? what do you do with the FX after you have converted? After you sold the position, is it a good time to get it back to Sing, or should I put it there a bit longer? So it become an FX speculation, right? So there is some pressure. I myself experienced that. Right?
Me too. I sell my Hai Di Lao position.
Exactly.
Then it sit down there for like,
So should I do it
should I bring
now?
my money back?
Yeah, is
right?
it a good
Is there
time?
additional problems?
And you start to analyze the FX chart. Whether so
yes.
that gives undue stress. And some of these Hong Kong stocks actually has quite a big ticket size to start off, right? It has, for example, it could cost like 7K, 20K
It's true.
per ticket.
It's true.
So how would younger millennial investors be able to do
You draw a line with you. You're the older millennial.
we are,
Okay. The older millennial, no problem.
we are
Okay,
the
okay.
older.
Millennials, okay,
So I might not be able to afford that in a single ticket either, right? Even as an older millennial. Because 20K is quite a big investment.
It's still significant, yes.
ETF maybe, diversified, but single stock could be challenging. So as a SDR format, we're able to reduce it in the form of ratios. So for example, a stock that is charging at this cost maybe $100 on the other exchanges, we could do a 5:1 ratio. So in Singapore, it only costs $20. If the stock is traded at $20 in the other exchange, in Singapore, 5:1, it becomes $4. So it becomes per share become relatively affordable. Even at 100 shares per lot, it's $400. So we have greatly reduced the quantum from 20K to 400, for example, to make it more easily accessible to investors. And there is, of course, cost advantages as well, because again, certain brokers may cut custodian fee for overseas holdings. But as you know, in CDP or even like most retail brokers, even if it's not CDP, typically there's no custodian charges.
Yeah. And you can take your CDP account, go and take share financing. So that's a different discussion. Yeah. Okay. Help us extend that discussion a little bit, right? So today instead of buying BYD, from Hong Kong, I buy from SGX, in the Singapore market. What are some? I mean, there's a cost advantage, right? What you've established, right? But from a costing standpoint, how would that kind of play out?
It has traded on the market for quite a while already, right? Costing wise, it has been pretty competitive. If you look at the Singapore investors, right, when they assess Hong Kong stock, as mentioned, FX is one thing. There's also a certain level of stamp duties that is involved in trading, buying and selling in Hong Kong, underlyings. But in Singapore, there is no additional stamp duty beyond the typical broker's fees and also exchange fees that is being charged. So in terms of transaction-wise, actually it's been very cost-efficient. And there is also no additional, I would say, management fee per se. So besides the transaction cost, when you invest into, for example, you're mentioning a BYD stock or rather SDR, you would also be getting the same price changes. So wherever the price of the underlying BYD move up by 10%, your underlying SDR will be also enjoying a 10% gain. So there wouldn't be any form of differences in terms of your price gains, of course, and price losses in Singapore compared to the underlying that is trading in Hong Kong.
Yeah, I get it. I mean, for a lot of retail investors that have invested in the Chinese stocks in the US market, it's pretty much the same, right? You don't actually own the stock of the original company, right? You are really buying a mirror product that mirrors the price movement of the original product that is listed, whether is it in Hang Seng, whether is it in the A-share market, right? Is that a simple way of educating the audience? You're buying a mirror for the price movement and not the thing itself.
Partially.
Okay. Yeah.
In fact, just like we were talking about the differences between L&I product and DLCs, right? I'm going to draw relevance to SDR and also, let's say, an ETF as well. ETF, as you know, when you buy ETFs, you are really buying a basket of stocks that are custodized under custodian. SDR, there is a custodian as well.
Okay.
So SDR, every single stocks that you hold, every single DR that you hold is custodian. It has to be backed by the underlying. So it doesn't really just mirror the price movement. The underlying does get custodized. In fact, it's fungible. Obviously, for retail investors, it's not that economical to change it for underlying stocks, especially if you are buying very small quantum, because there will be fees involved for conversion.
Okay. So to be clear, when I buy an SDR, there's a separate vehicle that actually owns the shares, right? And then that vehicle will issue the SDR, and then I buy the SDR. That's kind of the structure.
There's an issuer.
Okay.
Just the custodian.
Yeah.
They will have a custodian who will help custodize it.
Okay. And do they charge me a fee on that front? as a custodian, do they factor a fee into the price movement?
So the
You
price,
know what I mean, right? Because
I
sometimes
don't
they
know. So
don't charge.
for example, in ETF,
Yeah.
even if it's a few basis, there will be a
It will
fees on
reflect
your
a bit of
NAV,
the-
right?
yeah,
Every
yeah,
day
yeah,
they will
yeah,
deduct.
yeah.
For SDR, there won't be a this impact, which is
Okay.
why the price can closely mirror
Mm.
over 1 day, 1 week, 1 month, 1 year,
Mm.
as long as you hold them. There is some corporate action handling fee, right? And of course, the more details you can read on the prospectus. That
Of course.
Because I think SDR is an innovation that can kind of like bring like China stocks to the locals, Singaporeans. Because there's this thing called like tax implication, right? A lot of people didn't know that if you buy S&P, actually you're subjected to withholding tax of 30%.
I hate it.
And then on top of that, you still have the estate tax to think about.
It's
Yeah, and a lot of people didn't really realize that. Like probably one of the solutions is to kind of like buy a term insurance to protect it, or you can actually have a joint account with your spouse or someone that is close to you. Because I realize a lot of people, they are very into the US ETF space, but then they are not really protecting the downside risk of it. Yeah, like for example, in Irish domicile, there is also a withholding tax also. So I think investor got to be aware like which jurisdiction is not so good on the front of tax implication. Yeah, correct. So I think that is an important consideration. But SDR kind of like bring that product to you, and then you can trade in like SGD kind of thing. So that kind of like solve that implication problem. But is there
it
anything
true?
that I overlook if it's something like you can bring 10 cent over and then you can buy in under SDR? Is there any tax implication?
I would say at this point there won't be additional tax implication.
Okay.
Of course, like any other matter, seek your tax advisors for
Just to
advice.
be clear, right? No additional as in. Okay, so I think there are a few things, right? Some is more complicated.
Okay, so for example,
Yeah.
right, give you an example. There is withholding tax for Chinese companies,
15%.
but not Hong Kong companies.
Yes.
Right. So when you buy HSBC SDR, there won't be a. It's similar like buying it from Hong Kong. You won't have additional withholding tax. But for let's say if Tencent one day pays dividend, yes, you will be paying dividend. So it's a pass through. You won't be able to avoid it. Stamp duty is the one that you avoid. So you don't pay the 10 basis buy and sell stamp duty.
Okay.
Singapore. So exchange or stamp wise is your wave lah. But the withholding tax you can't avoid it.
Yeah, I was just about to ask you. Do your structure is such that I get to avoid the dividend tax on the dividend? That would be a great product. A lot of people would want it, but not so easy lah. Not so easy. Okay, cool. Any other things that for our audience that they need to be a bit more aware with this SDR? I think you made it quite clear already. But
it is effectively quite a straightforward product. It's a EIP, excluded investment product, which means that investors who may be more of a beginner into a stock market, probably is a product that they can consider. It's supposed to be made simpler for investing.
Fair. Interesting. So since you're the product guy, right, on SGX, right? Okay, without telling us like any sensitive information, are there more interesting things coming out? What is in the pipeline? What are you developing? What are some new things for the local retail investor audience? There are things you're playing around with,
because
thinking
now
of.
SGS, they are also trying to ramp up
There are more and more products coming out, right? So just want to hear your.
So I think you can see that trend coming for sure. Like Hong Kong SDR, US single stock Max 7 DLCs came out in the space of within a month. Certainly the momentum is building up. We are going to see more ETF listings as well. One of the upcoming one is Emerging Asia Select Index, meaning that it has certain countries that is in EM Asia, so Emerging Market Asia Select Index. It will be launched by Lion Global Investors. That is a product that allow investors to gain exposure. I think I mentioned some of them earlier on: India, Malaysia, Indonesia, Thailand. Probably today in most investor portfolio, they will have a lot of Singapore underlying, maybe US, maybe China. But these few countries in the surrounding or the ASEAN and India might be something that they can gain access to easily. We will be continue to launch more products as well, as you mentioned earlier on. And a lot of them beyond, I think can go beyond equities as well. Today, there are about 8 fixed income products. So one interesting trend that we see today is that retail investors are also using ETFs to gain exposure to bonds, right? And even to gold as an investment asset class. So millennial wise, I think they are opening up to more options.
Yeah, that's why they got 10 ETF in their portfolio. Doesn't mean it's correct. This is a different discussion. Yes. Okay, fair. Then I asked one politically not so correct question, right? Like I see SGX creating more and more this kind of like structured, or we collectively call structured products, like fund products, or like some of your leverage products. I see more and more of these things coming up on SGX, right? But the primary listings not so strong. Right, like not a lot of new primary listings. Is there a thought process around this, or you're just focusing on something, or is it just because the financial fund houses are a bit more active in this space? Just want to hear your point of view.
We are equally focused in both primary listings as well as, or rather company listing as well as products listings. It's certainly a market trend under risk environment, whereby the challenge of going into listing for many of new companies is higher. But it is a focus area for sure. And I think you do see the market review group they set up. Probably it's on the news as well a couple of months ago. The intention is really to encourage and facilitate more of such new listing on SGX.
Yeah, of course. I mean, I'm not dissing you guys, but as a retail investor, we concerned, right? Because we want more money to come in. We want a deeper market. We want more product lines so that we can make better, more interesting decisions. Interesting doesn't mean like all over the place. I mean, you want more product, then you can choose. There's a bit more competition. All these things will kind of probably in some ways could benefit the retail investors, right? So I think deepening the market, having more products, I think that's what we all want that, right? So we are aligned, okay? Yeah. So hope to see more things come on SGX. So thank you for your time. I wish you all the best. Hope to see more interesting products. Maybe in closing, do you have any last things you want to say to our audience? If not, we are good.
I think for younger investors, the trend we are seeing today is that they are already quite equipped with basic knowledge. A lot of them have also embarked on a regular savings plan habit.
Yeah. That's why Nicole Asset Management can bring down their fund price because it's a very big fund because of this RSP, right?
And it's a very, very disciplined approach because if you are unaware
don't think, right?
Exactly.
Just do.
So timing the market is more important than timing the market. I think it's a conventional wisdom, especially if you are not watching the markets on a day-to-day basis. DCA actually help you to smooth out your returns over time. And there are many avenues to do so. A couple of local banks and brokers, they do offer avenue to do DCA for their investments, be it for the local equities or for the global equities.
Long story short, you must understand your investment framework, develop from there, then pick the products that fit the framework. Okay, ultimately, investing is a journey, right? We keep improving, but sometimes don't be too overly experimental, right? Because usually when you first start, right, if you believe you want to do the structured method, you will learn, right? You will get down to the core,
get the basics.
Yeah,
right.
you will get it right one. That's why you listen to different shows, you read, you do all that. A lot of people will get it right. It's when the fund size start to grow, then you go through this very interesting time period where you're like, let's try new things, right? That is when a lot of weird things can happen. Right?
End of the day, there's no perfect mix of your exposure. You just need to have a comfortable level, a location that you can sleep soundly at night. You're not awakened by the market volatility in US or or even in daytime. It's not affecting your work. I think that's most important when it comes to investing.
It's true.
If you want to spend time in trading, I think that's a separate topic.
That's a different thing. Yeah. That's why the core satellite portfolio. If anything you want to go and read, you can probably read this. I think it's very well documented. So thank you for your time. All the best. See you again.
Thank you very much.
Awesome. And that's a wrap. We'll see you next week. Bye.